Okay, it is March 8th, 2024, and we're doing the 2023 trading year end review. Reason why we're doing this in 2024 in March is I actually started trading in March of 2023. So this is kind of the year to date review of my trades, how things have gone, done a little bit of reflection here as well. So we'll go ahead and dive into this. So, year end, we're at $19,172 in profit. That is before counting and factoring in trading fees, as well as any subscription services that I use. Those have come out to probably around, I want to say maybe $2,500 at most, $2,000 to $2,500. So subtract that from these trading profits, obviously, and then take out some taxes as well. But I also built a new computer for trading and for other various uses, programming and other kind of personal projects. But that was around $1,600. That was also from trading profits. So I did not count that in these trading profits. Those were from some scalp trades. So all in all, the trading profits are right around $20,000 for the year if we factor in the computer build. So I want to start off with mistakes that I see traders making in the market. The first one being not understanding math and probabilities. Trading is not, it's not gambling, right? It's not going into a trade and, hey, I hope this goes up, or I don't really have a system, or I don't have a price target. I don't know where I should put a protective stop or why it should go where I'm putting it. Or just, again, ad hoc trading. There's no real system or method to the madness. And in my opinion, trading is math and probabilities, right? Trading is identifying, hey, this is a good entry point. I have a case to go long on this potential trade. I see a potential upside here of maybe 10 points and a potential loss if I'm wrong of maybe 3 points. So that's, 3 to 1 risk to reward ratio. That's a trade worth making every single time. You only have to be right a third of the time to break even on those types of trades, right? So that's one thing to keep in mind, right? Mistakes a lot of these traders make. And I browse the forums on Reddit. I browse YouTube, the comments of different kind of traders that I follow or listen to, or market news and media. And that's one of the biggest things I see is people don't understand the math or the probabilities when they're trading. They just can't wrap their head around it. They don't have a system around the math and probabilities, making sure that they're only making trades that um, you know have a good upside potential, right? I mean, I don't want to take a trade that's a 1 to 1. If I could, maybe be right and get $10, or maybe be wrong and lose $10, it's not a good trade to me, because I a lot of times I don't see these guys having higher than a 50% um, you know hit rate, right? They're not accurate more than 50% of the time, so it's a losing proposition. And that goes to this risk mitigation strategy as well, right? I mean, having a risk mitigation strategy, making sure that you're not losing money day over day, week over week, month over month. I've found, especially the mental side of trading, which I think is a huge proportion to trading. If you don't have a proper risk mitigation strategy, you're done. Like you're going to blow up your account if you don't know how to take profit, or when to take profit, or how to minimize your potential losses, whether it be trading too big or not adjusting stops. That is inevitably going to blow up your account, whether it be because you're not confident anymore as a trader, you're making bad trades, you're afraid of losing at some point. At some point or another, you will be if you keep losing. Risk mitigation is so important. And then I see people not having a strategy at all, right? I mean, they go into, a lot of the Reddit threads that I follow, there are people that are, hey, I want to get into trading. Well, why do you want to trade? Well, I want to make money. Okay. Well, what do you know about trading? Well, nothing, right? Like, I've listened to YouTube channels of these gurus that are actually scamming you to sell a course, right? They're not making money trading. They're selling courses. So their strategy is, blindly follow somebody else, blindly follow this, technical indicator, this RSI, or uh, TWAP, or whatever it is, right? If, they don't, even when they backtest, right? I mean, I don't think backtesting is really a relevant strategy either, because past performance is not indicative of future performance. So not having strategy, not understanding the strategy that they have is definitely a huge mistake that I see. Relying solely on technical analysis as well, especially for the guys that are trading the S&P. The S&P does not move solely on technical analysis. The S&P is consisting of various Fortune 500 companies, right? There's 500 Fortune 500 companies that are in the S&P index, the S&P 500. These people go and they trade S&P futures, the E-mini futures, and they don't follow earnings reports. They don't follow what's going on in the market. They don't follow interest rates. They don't follow how that impacts the market. They don't follow currencies. They don't follow any of those things. They solely rely on, oh, we're oversold, we're overbought. I see this indicator is triggering to this. I back tested this and it worked, 10 years ago, 5 out of 10 times, 6 out of 10 times. That is relying solely on technical analysis. And then you get these market news events that I've seen time and time again. Today, the non-farms payroll. We have, um, Powell speaks at a press conference at 2 o'clock on a random Thursday or Friday, and the market moves, and people are not following these things. They're following the technical analysis. Those things are important to follow. Technical analysis is important just as much as the fundamentals are, following what is actually going on in the market news and the things that are driving the technicals, right? The things that are actually driving the movements in the market that are resulting in the technical analysis that you can even perform on the charts. So that's that. Trading a market they don't understand. So this again goes to the S&P, right? I mean, people don't even understand how this market moves. They just go in and they start trading based on charts and patterns and mathematical formulas and equations. And you don't understand a market, don't trade it. I mean, really, you wouldn't invest in a stock for a company that you don't understand, right? So don't trade markets you don't understand, right? I trade precious metals, so gold, silver, platinum, palladium. I like the energies as well. I haven't done as well with energy trading as I'd like to, but I try to develop a deep understanding of these markets. How do they move? Why do they move? How are they used in industrial purposes, right? Silver, definitely a good component of that. Silver is a storage of value, but it has a very core industrial component to it. So understand, why do prices move and how does this market actually work if I'm going to trade this market? And I personally like picking a market that I can understand and trade. The other thing is thinking that trading is a get rich quick scheme. Trading is a job. It is systems. It is patience. It is a long-term strategy in order to be successful. There is no get rich quick in trading unless you're willing to risk a substantial amount of loss. Anytime you have a substantial upside to quote unquote get rich quick, you have the ability to have a catastrophic loss if you're wrong. So, and to me, that's never worth it. It's never worth potential loss of everything in order to maybe 2x your portfolio, right? It doesn't make sense to me, because doubling the money that I have now, it's good. It's not life changing, but going to zero is life changing in the wrong direction. So, worth mentioning there. And then a lot of people don't have the capital to trade, and they get into it, right? They've got $1,000, $2,000, and it's not enough, right? It's not enough to be able to take the trades without an emotional bias, a cognitive bias of, I only have this much money to trade, I have to increase this account, right? So you definitely need enough money to trade as well. There are e-mini, there are different options you have to trade with smaller amounts and smaller sizes, but I personally suggest people don't trade unless they have at least $10,000 of money that they could afford to lose. So, for my takeaways of what's worked, for me, it's been trading gold, silver, platinum, palladium. It's been highly lucrative. I've been very good at these. Predominantly gold and silver. Those are my two that I really understand, but I've done really well with platinum too, because platinum is very volatile. It's very up and down in a consolidated range. And um, I've been very profitable with platinum. I've done really well with it. Palladium has been a little bit more, volatile on the downtrend, where I've been going long on it on certain kind of bottoming scenarios where it reverses. And palladium is oftentimes used in, or it is used in vehicle manufacturing of whether it be engines inside of when we talk about exhaust systems and those types of things. And those things are going away as we shift to kind of the EV world. So palladium is definitely losing a substantial amount of its value, but it's been a very, very good commodity to trade for me personally. The other thing that's worked is sticking to these 3-to-1 risk to reward ratios. And I see it pretty often where I'm looking at silver, it's trading at $22 an ounce. I see a path for us to get back to 26. I don't see that much downside of it going below 20, right? I mean, there's just really good risk to reward ratios. And anytime I've stuck to those, it's done really well for me. Even if I take profits early, even if I don't ride it out all the way, I've found that the 3-to-1 risk to reward has been very good for me. Anything below that is usually not worth the trade. I can make a little bit of profit here and there, but I usually end up losing. The other part is not risking more than 5% of the portfolio. So for any one given trade, I try not to lose more than 5%. If I'm trading with 50,000, I don't want to lose more than $2,500 in one trade. That's just the way it is. It's very easy to blow up your account if you start taking too large of position sizes. So 5% is really kind of the cap for me. Sometimes I go a little bit over it. Depends on the trade, depends on the risk to reward ratio, but that's kind of a pretty solid rule that I've had success with. Taking profits sooner, it sounds counterintuitive, right? And I've left a lot of money on the table, but I've also avoided a lot of loss, which has been really good. I do think if I stick to those risk to reward ratios and I maybe hold a little bit longer, I can make some extra profit. But I don't think anybody's ever complained about taking a winning trade, right? So anytime you're taking a profitable trade, it's good. It doesn't matter if you're taking money off the table too early, as long as you're in the green. And then FOMO is a big one, right? You see a you see a price move and you want to get in on it. You want to jump in on the bandwagon, and a lot of times the rug gets pulled because people take profits. So the market is very unforgiving, and FOMOing in is usually not the best thing. You miss the move, sit on the sideline, wait for the next opportunity. So don't FOMO, stick to your systems. And for me, I've got very clear systems that I can talk about in another video for when I trade, how I trade, when I enter, and when I exit. Sometimes it's a little bit more based on the fundamentals or just the more broad sense of the price and where it's going, but sticking to the systems is always good. So, what didn't work? FOMOing in, I've definitely done that a couple of times. You get in too high, you get in too late, and then the rug gets pulled and you get stopped out. Getting aggressive on volatile, what I would call third tier commodities like natural gas and oil, these commodities that are more volatile that I don't necessarily like to trade. I don't understand them as well, and they're a little bit riskier, I would say. Natural gas, it's been at a historic low in the past couple of months, and I've tried to trade that, and it's been really hard to catch the rebound, catch the bottom. Trying to predict the bottom's never usually good. So just doing smaller positions on those types of commodities that are more kind of third tier to me, like natural gas and oil, will definitely be helpful. Going against the trend. So if I am looking at new all-time highs of a certain commodity, let's say gold, which has happened this past day, trying to find and predict the top before there's confirmation of it as we're hitting new highs, right? Going against the trend before a reversal confirmation is very catastrophic. It's not good. It's not a good system. It's something that I have to work on. Trading too large positions initially. So I don't do this anymore. I now scale into positions over time, even though it means I'm going to make less profit if I am right initially. A lot of times you're not right initially. You get in a position, the price goes a little bit lower. I am now using that as an opportunity to get in at cheaper prices, as opposed to, as long as, obviously my stops are not hit and my thesis is still intact. Trading just smaller positions to start and then scaling in over time at cheaper prices. Another challenge that I've run into is fully stacking on multiple trades, whether it be on the long or short side. A lot of times these commodities move in the same direction. So if you're stacking platinum, gold, silver, palladium, they're typically moving either up or down collectively, right? They're not, one's moving in another direction, the rest are going up. So I found a couple of times where I was stacked on the long side for multiple positions where my thesis was just wrong, my timing was wrong, whatever it was, and I was losing on multiple trades. So definitely something to be aware of. And then overly focusing on one specific guru. So this is something I actually started doing at one point. Was I found a number of mentors, people to follow in the industry that I respect or understand kind of their fundamental or technical analysis, but sticking a little bit too closely to them, right? And following maybe their words for verbatim has not been good. And I now look to multiple, what I would call gurus, multiple sort of people in the market that I trust and respect, gather their opinions, see where they overlap, and then also form my own opinion before entering a position. So going into 2024, goal is stick with the systems, avoid FOMO, be okay with losing, adjust stops early and often, or at least when my analysis changes, get out of positions. Don't, be okay with adjusting stops, getting out if you need to, and start small and add to the positions over time, like I mentioned earlier. Start with a smaller position and then add over time as long as the thesis is still intact. So that's it on my end, and I appreciate you guys listening in. And we will talk soon, likely next week for the next trading update. Thanks.